40. So that's a more decisive, and I think Axis has got something to do with it. It'll come up on your screens, but 0.4% lower on Nifty Bank straight off the bat. Axis is down 5%, as you can see, and I think outsized sort of pressure on the Bank Nifty. Mid-cap index is flat. The small-cap index, perhaps, I think, coming up should come up flat as well. And the Nifty heat map will give you a quick sense of how we are starting, but it's all about stocks, so we want to get to stocks very, very quickly. What do we have on your screens? 25-odd names are higher, and about, not 25, 35 names are higher. About 15 stocks are in the on the downside, but Axis really is putting pressure. Surbhi.
It's a classic bull versus bear on Axis. I mean, the bulls will say that in longer term it's actually good. It's a sign of strong prudential management. But the bears will say, hey, Q1 was bad and we weren't prepped for it. 4.5% down on the stock as we speak, but it's cutting its losses from a 6% gap down. So let's see how this plays out. What else is weak? Bharti Airtel, Kotak Mahindra Bank, SBI, SBI Life, Bajaj Finance. In general, financials are weak. And the knock on Axis has taken the Bank Nifty down 0.5% as well. ICICI Bank is also a little weak. And the others are not able to offer much of a counterweight. I mean, HDFC Bank is just 6 rupees higher. SBI is also on the lower side. So banks are weak, short point. Let's look at Wipro. Wipro is a bright spark on the Nifty this morning, 3.5% up. Remember, the first quarter was soft, but deal wins are looking very good. Commentary for the second half is strong, and the market likes that. So 3.5% up. Jio Financial reported numbers. Growth is picking up. 1.25% higher on Jio Financial as well. Other gainers on the Nifty. Once again, the metal stocks are continuing their shining ways from yesterday. So Tata Steel, JSW Steel, maybe global risk on mode. Global markets have been holding up as well. That seems to be working for this part of the market. Even Hindalco is up 0.5% higher. So metals are shining bright. Aside of that, then it just completely flattens out. Some buying on Infosys, some buying on L&T. Let's look at Reliance finally before we move to mid-caps. Reliance ahead of numbers. Very quiet, just about 2 rupees on the higher side. Nifty down 17 at this point. Nigel.
Well, a few stocks that are catching your eye from the broader markets. Novoco, the numbers were good. I'll be interested to see whether or not it can sustain this 8% gain because, the IPO came at more than 500 rupees, but they're doing the right things. If it wasn't for Varadaj asset that they've taken into their books, because now we'll have to wait by to see how they turn that around in the next 2 years or so. But no worries with the numbers. Realizations up, cost under control, debts reduced, and they have valuation comfort as well. So let's see whether or not it can build onto those gains. For the time being, an 8% pop, I think, factors in the good set of numbers that we have seen. The other one I'm looking at is Afcon's Infra. Well, that's up close on 4.5%. They won a large order. So that's why the street likes that. That one, 4.5%. Good going out there. Wipro continues its winning ways. And SmartWorks co-working listed yesterday, good gains out there, building onto the gains today as well. So SmartWorks, in fact, up close to around 2% as we speak. Lurch Avenues Tech, that stock, in fact, was much higher in yesterday's trading session. It ended at the circuit. Today, there is some cooling off. There is an Anand Rathi note that I'm looking at. They find valuations a bit stretched at around 68 times forward earnings. Hence, they initiate coverage with a hold rating on the stock. 230 rupees is the target price. Some cooling off after the big run that we've seen on that one. And Navkar Corp as well, I think that came out with a set of numbers. Large volumes today. It's down close to around 1% or thereabouts. So, though we have the headline index, it's more or less flattish. Stocks in the broader markets doing a thing of their own, bouncing around.
Well, 0.07% change on the Nifty at this point. So large cap, the Nifty index not doing very much at all at this point in time. Let's welcome in Prateek Gupta, who's with us, CEO and co-head at Kotak Institutional Equities. Prateek, great to have you with us here on the program as always. Thanks for your time. Do you think one of the reasons, sort of almost primary reasons, of course, earnings have been tepid, etc. We all know that, but there's so much supply, right, which is constantly hitting the market. Just take SBI's 25,000 crore round, and so many others who are kind of sort of coming to the market and quietly raising money, successfully raising money. There's a fair bit of supply, so money is getting sucked out of the system. What is your sense, on balance, because very, very evenly, almost sort of, these levels, at least at the index level, things are pinned to the board, not moving very much, very tight band.
Yeah, good morning, Prashant. I was actually just discussing with someone earlier this morning that our market seems to be, if you remember the old Ajit Mona Darling jokes, like in a liquid oxygen state. pretty much range bound. You've got, on one hand, you've got the very weak earnings outlook, as you mentioned, valuations which are expensive. Nifty is trading at almost 22 times 1 year forward. And you've got a huge paper supply pipeline. We had SPI yesterday, many other large IPOs and a lot of blocks and QIPs in the pipeline. So that's going to sort of cap the upside. And on the downside, there's a lot of support from continuing local flows because your alternatives in fixed income property are no longer that attractive. You have the prospects of a much stronger second half. So there's hope that earnings will recover in the second half. And then you've got the US dollar weakness, which will hopefully trigger EM inflows as we go along in the next 3 to 6 months. So sort of stuck in a range-bound mode for the short term and pinned to the wall, as you said. So yeah, it's pretty frustrating for a lot of investors who are either waiting for a market correction to buy or waiting for a market rally to sell. So pretty subdued activity at the time for the time being.
That line, Pratik, I was hoping that when you started with the Mona Darling line, I thought you'd say it. मोना डार्लिंग इसको लिक्विड ऑक्सीजन में डाल दो लिक्विड इसको मरने नहीं देगा ऑक्सीजन इसको जीने नहीं देगा that's the line.
Gentlemen, out of the park this morning. I went to Google immediately. Ajit, Mona Darling.
I mean, how can you, Nigel? I mean, you're not that young. This is,
now it feels like a Friday. Actually, thanks for that, Pratik.
But you have heard about this?
Old movies playing in the house at some point in time.
Come on.
This is not 90s. We're like 90s kids and all.
This is iconic.
No, but okay, to bring this back to the market, Pratik, please elaborate. Now, who is the Mona Darling? Which sector? What is the liquid oxygen? Is it the liquid flows? Please elaborate on this very, very interesting analogy that you picked up this Friday morning. Because if you're talking about flows, then that liquid oxygen is not even there. Where are the FPI flows? Half the year is gone. We thought there'll be plenty of liquid oxygen, but it's not coming.
No. In the joke, the liquid is the thing that prevents, will kill the guy, and the oxygen is what will give him the support to live.
Okay.
So the liquid in this case, what will kill the guy is really the valuations which we are at 22 times. Very few stocks are at attractive valuations. Earnings growth, as Prashant was saying, is pretty pathetic. If you look at the large sectors, you look at IT services, consumer, banks, you'll get, at best single-digit earnings growth this year. So that's sort of what's capping the upside. And in terms of the downside support, you've got local flows because, like I said, money is not going anywhere else. It's coming into equities, risk capital, that is. And you have prospects from, for example, you could see the impact of the rate cuts by the RBI and potentially even more rate cuts given the very low inflation print we saw in June. You could see, finally these things feeding through into the economy and the long sort of, and you could see government capex coming through in the second half. Post-monsoons, we could see a rural recovery. All of these factors should come together in the second half. So therefore, it's sort of pretty range bound at the index level. Obviously, individual stocks are doing their own things, but at the broader market level, tough to see this market moving out of the sort of range.
Now it makes full sense, Prashant. So liquid ise jeene nahi dega is the valuation and the earnings. But oxygen marne nahi dega. That's the retail money flow. Now we understand.
I remember the dialogue, but you got to go with Ajit's delivery. I mean,
you nailed it.
I can do it, but I don't want to do it.
Over it, Prashant.
And you should try it.
Yeah.
On popular demand.
Lights, camera, action. Prashant.
I'm not going to do it. Go on. By the way, just to take that point forward, Ramdevji was on, right? And I don't know if you watched that conversation, Pratik. This liquid oxygen, basically he put it another way. This is, of course, but Ramdevji said cap and floor. The cap, according to him, is all the supply which is coming in, and the floor is all the supply, all the sort of money which is coming in.
The retail money, yeah.
So, and that's the liquid oxygen, which I think that's another way to describe liquid oxygen.
All right, interesting Friday morning, Pratik. We started off, we had our top 10, and Surbhi was asking Reema, the glass is full or half full? It's a Friday morning, so I was just wondering what's going on, and now we have a slew of jokes as the markets open. Let's get back to earnings. We spoke to Mahesh of Jefferies last week, and he said quarter one is going to be weak, but he's breaking for a very strong bounce back in quarter two earnings. And the rationale he gave us, that it's going to be on a softer base. Some part of this liquidity that's released into the market will start picking up. And since we are hit by early monsoons, maybe the monsoons recede as well earlier. And besides that, the most important is Diwali is relatively earlier. So spends will pick up in September. Are you in that camp that believes that we'll see a good earnings recovery in Q2? And for the year, you're still sticking to that 12% earnings growth?
So yes, Nigel, we also believe that the earnings growth outlook will be much better in the second half. For the June quarter, our projection is at Kotak that the Nifty earnings, for example, will be growing only by about 4.5% YOY. Whereas for the full year, we are projecting about 11% for FY26. So clearly that means in the next 3 quarters, we should see a much stronger earnings growth. Having said that, a lot of it is priced in already, both the negative news as well as the second half recovery, negative news of the first quarter and the second half recovery. Just look at the valuations of where all the stocks are trading at. Like I said, you look at the consumer stocks, the IT stocks, the bank stocks. They're already sort of, I don't think there's going to be a major surprise, barring a few odd stocks here and there, that broadly almost every investor is expecting a very weak set of earnings from the first quarter and a pickup in the second quarter. I think the main market moving events will be something other than what's already going on, all this second half recovery. It could be things like you get a favorable trade deal with the US, for example, or perhaps on the downside, an unfavorable trade deal. So that could be one. Second, you could see some government action in the form of, say, perhaps petrol and diesel price cuts at the retail level. That could pump some money back into the economy. GST, we think there'll be just some minor tweaks, but perhaps there could be something more over there. But I think the real big trigger will have to be things like government capex coming in a big way in the second half. And that's always a bit tough, tricky to project how much of it will be driven by the center, by the states, the PSUs. So that's really where we are. So we are sort of expecting a much better second half, but it's sort of priced in. So to break out, you need something else happening, which at least at this point in time, there's nothing going on.
Okay, so all right, Prateek, let's sum it up then with what should be done. I mean, you described the situation really well, and I think this is the reason why we're not getting that deluge of foreign flows. We started the year expecting that US exceptionalism will end, and it has, but it's Korea and China where the money seems to be going. So in this context, what should investors be doing? Where do you see some prospects of growth and some valuation sanity? Leave us with the top ideas. I think defense is something you've always liked. What else?
So firstly, on the foreign investor side, I'd just like to highlight that most global investors are still neutral to largely underweight India, just given the expensive valuations. India has underperformed the MSCI EM index. You mentioned Korea. Korea is up 32% this year in local currency terms. Other markets like Hong Kong or Brazil and Mexico, they're up 15, 20%. So India is clearly underperforming. But even then, people are staying away. And you've seen the flows into the FPI flows into India last few weeks. We haven't seen that much coming in. Now, as far as the sector preferences are concerned, in this sort of a market environment, either you go with companies where you have strong earnings growth visibility or where valuations are in your favor. And that's a tough one to find. So we still like the banks and the NBFCs and the insurance companies where earnings growth is not that great, but at least valuations are somewhat reasonable. We still like the hospital space, the entire healthcare space, where, again, in this case, valuations are not supportive, but you have a very strong earnings growth outlook for the next couple of years. Hotels is another area. Telecom is another area. So these are sort of the sectors we like. One general theme we would recommend investors, at least for the time being, to stay away from is export-oriented plays. These are like IT plays, the global auto ancillary plays, or the metals. We believe a global slowdown is in the works. The impact of the tariffs, etc. Already we're seeing this in China slowing down. US, we think, will slow down in the second half. So when two large engines of the global economy slow down, tough to see the overall global economy not slowing down. So overall, we would stay cautious on the global export plays, focus more on the domestic plays.
Okay. All right. Prateek, thank you very much. A great conversation as always. Insightful and, might I say, very entertaining. Brightened up our Friday morning. You have a great day and we look forward to connecting.
I hope you'll...
By the end of this day, you'll have to enact. If not on air, off air, for sure.
You'll give the idea to Sanjeev, Prateek. The research note titled Liquid Oxygen. I think it'll be a super hit.
Prateek, I'm sending you an invite for drinks later this evening and, we'll do all the enacting over there. All three of us and you.
Okay.
All right. Thank you very much, Prateek. Appreciate you joining us as always, and good chat. And look forward to the next one. Guys, the market is doing... let's just put the Nifty up for a quick bit, and then we'll just move on to our next discussion, which is, of course, another asset class, equities, real estate. Real estate is, of course... has been doing pretty well. 30 points lower on the Nifty. The real estate index is up about 1/3%. But so it'll be commercial, residential. What are we talking about?
Real estate and most parts of it are, looking very, very good. We're putting the spotlight now on the office market. India's Office Real Estate Investment Trusts, also known as, of course, REITs. Their outperformance to the realty index has been quite telling. In fact, we're talking about 15% capital appreciation in 1 year. The key driver has been the underlying strength of India's office real estate market, triggered by heightened demand from GCCs. To talk about this and more, we have with us Soumi Thomas, Executive Managing Director, Valuations and Co-Head at Capital Markets India at Cushman & Wakefield, and Vijay Agarwal, Managing Director at Aquarius Capital. Soumi and Vijay, thank you very much for being with us. REITs are definitely coming center stage. And I know that because, I'm looking at it from a personal finance angle, just the simple returns are becoming too interesting to ignore right now. But the question is that, is the cycle just starting? Can it continue to be so good? Because it's largely a play on the booming office market. So, Soumi, why don't you lay out the ground for us first in terms of just how rentals are moving up? Is it pan-India or is it specific markets, say, in Bengaluru, in Mumbai, which is where this office demand is coming in from?
Thanks, Surabhi. I think it's very important to note that most of the office markets across India is doing quite well. It is driven by the GCC demand, the global capability centers. There are headwinds on the IT sector, but we need to really look at the importance of the GCCs for India. So it is most of the GCC market, like you said, Bangalore, Pune, Hyderabad, Chennai, even Gurgaon for that matter, is doing quite well. So the underlying growth on rentals is more than a inflation-adjusted rental growth. So 7 to 8% rental growth we are seeing in most of the core markets of real estate, not necessarily across the outskirts as well, but the core markets. So the talent pool availability is a big factor for GCCs. So they're willing to pay more rental in the preferred micro markets to attract talent. And that's why the rental growth is doing well. And we can see that in the REIT performance, we have a 15% growth in the last 12 months across most of the REITs. And they're doing quite high in occupancy. We have close to 90% occupancy in all the three listed office REITs. Of course, the retail REIT is doing phenomenally well. That's at 97% occupancy.
Soumi, just to follow up on REIT returns, and correct me if I'm wrong, I looked at some data, but that was, I think, a month or two back. Average returns have been ranging in the mid-teens. And, net of tax, they're looking very attractive at a time when the equity market is barely giving you, 10% in a year. Is that sustainable? I mean, what is a realistic expectation to have in terms of IRR when it comes to REITs?
Absolutely. You said it correct. In the today's market, it's a sustainable returns. We are seeing that quite attractive returns because of three factors. Like I said, GCCs, supply constraint is still there in the market. The core of the markets, like, for example, BKC in Bombay or Goregaon, Powai, these kind of markets, it's difficult to create new supply. So existing tenants are renewing at higher rentals. Like I mentioned, it's very important for these companies to be in the right area to attract the good talent. So we are seeing a mid-teen returns for most of the REITs. And I think with the GCC demand picking up in India, it is quite sustainable.
Gentlemen, morning. Good to have both of you here. Soumi, Prashant here. Soumi, now, when you look at valuations, right? When should one buy these products? I'm assuming when interest rates are high, right? At the top of the cycle in that sense, right? Yields are high. So you get, there are better pickings. Is that the state we are in right now?
Interest rates obviously are an important factor to give returns, but it's also important to look at the underlying demand factors. We came off at COVID, which created headwinds around the return to office scenario. And even today, maybe some of the developed markets, even in Asia like Japan or Singapore, you probably don't have very good performance in the REIT market. But markets like India, where return to office has become a reality and people want them to come to office for all kinds of reasons, including the new headcount they're adding every year. And they have not met their managers, or they've not really bonded with their colleagues. And innovation and ideas will only happen when you come to office. So we are seeing quite a strong trend of return to offices and a huge demand from the GCC space. So interest rate is one function. Of course, we are already seeing the benefit of interest rates, already reduced by 50 basis points recently.
Somi is, and maybe Vijay can also come in on this if he wants to. It's an asset class which is just about taking off in India, right? I mean, there are 4 listed REITs, three are in the commercial space, 1 in the retail space. There is 1 more which is coming. I think Sattva is coming to the market. So it'll be 5, but total market value is $12.5 billion. In the US, for example, it's trillions of dollars. But AI, it's a slightly off-tangent question. If it increases productivity, reduces the need for as many employees, as many seats in the office, fundamentally, where does that leave? Where does it leave things? If either of you wants to take that question briefly.
I think I can take it. I think we have to look at the AI, how AI will impact the demand for office space. I think it can have an impact on the very lower level, coding level, not broadly across the. We will not see that the AI will replace human being completely.
No, my point, Vijay, is, of course it will not. But it's like a pyramid, right? Any organization.
Yeah.
I mean, as you go higher, there are lesser people. The vast majority is the lower end. But if the lower end, as you say, is essentially going to get disrupted, then you don't need as much office space.
Yeah. So we had seen these things when the banks were getting digitized. That time also we had a lot of concern about the manpower, what will happen to the manpower. And if we see our data for 30 years, the banks have increased their manpower strength. So looking at, I think Somi can also chip in here. We don't see.
I'll probably take it. I'll probably take that question in a different manner. Just look at the absorption that Nvidia is doing in India, or there are certain multiple examples of chip companies and AI-driven companies creating India as the most important base, right? So we have seen some of the other large cloud players also increasing their presence in India. So what is really happening, Prashant, from an Indian context is that India is the cornerstone of a strategy for AI for most of these companies.
Yeah.
The kind of work that is happening has moved completely beyond the call center, the BPO, the low-end coding that Vijay just mentioned. We are talking about doing very high-end R&D work in India.
So that point is very well taken, that there is demand. GCCs are booming. And, that's showing up in office demand as well. I have a very simple question to you, gentlemen, from an investor perspective. Now, you can either invest in REITs or you can simply buy the underlying stocks. And a lot of these companies have mixed developments. I mean, they've got office developments as well. What could be potentially a better bet, say, over a 3-year period? Vijay, what would you do? Buy the underlying real estate stocks or invest in REITs?
I will take it differently. How is your risk appetite, basically? If you see REITs are a very stable income product and it replaces your bond yields. And suppose if you are looking to invest in a stable return product like a bond, then I would suggest you invest in the REITs because REITs give you a much better return than bond. With the same security, because underlying you have a real estate and real estate value will never go down in India, definitely. So that's the underlying assumption. And you, instead of 7-8% and now 6% with the rate cards, here you are getting a 12-13% overall return. So I'll suggest to do that, invest in the rates. But if you have a risk appetite, probably you can go for a stock investments in the select real estate development companies which have a mixed portfolio. You can have a Phoenix also, and you can have a Oberoi Realty, and Lota is increasing. So you can play the game. But suppose if you want to buy and forget, then REITs will be the better option. If you see a Nexus REIT, it has given more than 25% return, yearly returns. So that's a fantastic return. You can't get in the stock. And the best part for REITs is that it doesn't go down like a stock market.
That's the thing, and investors are very savvy. They're hearing you say 35% return. They're very quick to tweak their portfolios where they think there's perhaps other value. And I think REITs are going to become quite a defining product that people will at least look at in the years to come. Thank you very much, gentlemen, for joining in on what is an interesting conversation, a very, very interesting asset class. 35% return in last 1 year, Nigel.
Well, Somi and Vijay have given me some food for thought. We'll do some analysis on this over the weekend. Thanks a lot, gentlemen, for joining in. Look forward to catching up with you all rather soon. Well, let's move to another corporate then. We have Tata Communications that's on our radar. We have Mr. Lakshmi Narayan, the MD and CEO at Tata Communications, who joins us on the show. Hi, sir. Good morning. Thanks a lot for joining in. Well, in month of June, when you held your analyst meet, you deferred your ambition of doubling your data revenue to around 28,000 crores by FY28. That implies a CAGR of close to around 13%. Now, in Q1, the growth is around 6%. Do you think you get to double digits from next quarter onwards? And for the year, what kind of a number in terms of growth can you deliver? Double digit on the cards?
Yes. Hi, good morning. If you look at our data portfolio, the digital year-on-year has grown close to 17.4%, which is very good given the macro conditions that we are operating in. The data growth as well year-on-year has come in just shy of 10%. So we still believe that the macro conditions that is in effect. There are pricing pressures. The core connectivity particularly has undergone some churn on pricing and some specific SAARC countries related issues that we have had. But these are, we think, are the blips that we have to encounter on the way. But talking about the long-term ambition that we set out, we still very firmly believe that the upsides are very much there, given the areas of investment that we're doing in the digital fabric.
So data revenue growth will return to double digit in the coming quarter?
No, we don't give any guidance. The only markers for us are, since we referred to the Investor Day, we called out that our relevance to our customers are increasing, where we said that our 10 million customers in the last 4 years had doubled. Right? So, and our BFSI segment, where we focused, again, almost doubled in the revenues. So our relevance certainly is increasing. The order book this quarter is better than the previous quarter.
Yes.
Even last year, I had called out both in Q1 and Q2 fairly good order book. That came on the back of some lumpy deals. And Q1 again, we have done quite well in terms of order booking. So and the funnel addition is another good indicator. We have had very good funnel additions both in India as well as in the international market. So I think we feel very, very good about the traction we're getting in the market, the relevance that we see of the portfolio that we have with our customers in their transition journey. These are the two more important factors to me. But the macro is something that we can't control, and therefore I won't be able to give you immediate forecasts on the quarter or the year ahead.
Right, but 28,000 by 2028, you're saying that's the ambition, and you don't think that'll get pushed?
That's very much intact.
Got it. Let's talk about the bright spot then. You mentioned, right, digital revenue, that's done well for you, 17% up, 17.4%. Now you want the share of digital and data revenue to go to 65%. Couple of questions on this front. What's giving you that confidence? When do you get there? And when you're talking about the 65% contribution, are you factoring in some inorganic growth?
No, all of this is
organic.
Organic, yeah.
Okay.
Over the years, all the components of our fabric has significantly strengthened for us, right? So I can talk about each of the fabric, but each of the fabric, whether it's network or the cloud and security, or the interaction fabric and the IoT fabric. All of them we have significantly invested and strengthened. The cloud, network and security and the interaction has done very well in the last in this quarter and the last year. The IoT fabric is somewhat muted compared to the past, but all the fabrics, we have complete belief in that would do well. The second aspect of it is some of the new products, that we are working on, and we again called out as some of the strategic bets in our Investor Day. So for example, the whole cloud, the security, where we bundle all the capabilities of CDN, the firewalls, the next generation firewalls, the API security, and all of that. That we believe will be a big uplift. AI Cloud again is a big investment, and AI Cloud, particularly combined with our interaction fabric, where we have Kalera AI, where we think that inferencing is going to become more and more important as we go into agentic AI. Our combined value proposition of our own AI Cloud, combined with the agentic AI on top that we provide us in the interaction fabric, will be a great differentiator in the market. So these are some of the bets that we are investing in.
Yeah.
And we think that will get us to the ambition that we have stated.
Sure. So just walk us through what some of these investments and these bets, what they will mean for the margin profile of the company, say for the full year, stepping into next year. Because while in the quarter gone by, your margins improved sequentially, and you were at about 19 odd percent. In the past, you were at higher margin levels. You were at 20% plus. So as these investments into AI, agentic AI, all of they continue, does it mean lower margins? As a trajectory?
Yeah. No, I think, again, in our ambition, we've stated that we will want to get the overall portfolios to be at least at 23%. Our range is 23 to 25. And there are two factors, here. One is in the core connectivity itself, there have been some pricing pressures, and the core connectivity has not grown as much as in the past. So our core connectivity, for the margins to do well, we said it should be in the mid-single digits or low to mid-single digits. That has not happened over the last 2 quarters for various reasons. And one of the primary reasons that we called out is issues in the SAARC countries, and that has muted the core connectivity growth. Now, that is one big contributor for the overall margin. The second is the overall digital portfolio is negative EBITDA at the moment, and each of the fabrics. So the next-gen connectivity does well. The cloud and security, there are early stages, so we think that will come back into contributing more positively. The interaction.
But by when, sir? So if you could give some time indication, you said your ambition is to get to 23% plus margin.
Right.
By when? And does it get worse before it gets better? Can margins fall to sub 19 as well?
Yeah, the timelines, we again gave out is the medium term of 27, 28. Our first goal in the digital portfolio is to get to an EBITDA neutral position. So today they are all negative. So I don't want to give a specific timeline again, whether it will happen. It will take a few quarters to get there, but the trajectory is the right trajectory that we are moving in.
Got that. Mr. Lakshmanan, the other sort of question, of course, is every industry is in some way or the other getting more competition or technology disruption, et cetera, et cetera. Prashant here, sir. The news this morning, basically, which suggests that, and this is a story from CNBC, that companies like Meta, Google, et cetera, are laying out, basically subsea cables, tens of thousands of kilometers. I don't know if you've seen that story.
Yes.
That is, in a way, kind of sort of, directly in your line of business. How does it affect you, sir? Is it a bit of a threat?
No.
Competition? Go on.
I don't think it's a competition. It's, our customers who used to lease and buy from us are now investing in their own cable systems. And this cycle is to be expected. So it is not a threat. We are also diversifying into other customers. So, these class of customers we call as the OTT customers who,
Mr. Lakshminarayan, these class of customers, the OTT ones, right? I mean, not what you describe. I mean, I think you describe internally them internally, Meta, Google, etc. as OTT.
yes.
And this would be how large as a share of your numbers, sir?
No, we don't split that out, Prashant. Both the hyperscalers, the OTTs, and enterprise form the bulk of the core connectivity.
Yeah. So if they are starting to build out their own networks,
Yeah.
I mean, that is essentially
So that,
problematic, isn't it?
it's not a new phenomenon. It has been happening. Google, AWS, Microsoft, all of them have invested in their own submarine cable systems. It's not a new phenomenon. That has been happening for a while. They also, at the same time, buy from us because they do need diverse paths. The cables get cut under the sea. That's also a phenomenon that is increasing, and that causes resilience issues for these customers. So they do, while they build, they also buy extensively from other parties. So it is not that one is replacing, and their data needs are only growing. It is not coming down. Right?
No, that's the reason why I'm asking, right? I mean, this is the fastest growing part of the business. I mean, not for you, I'm saying generally, if you look at industries, hyper growth in these segments. But you're saying that this has been happening, and it's not as if the pace of change is quickening. I mean, it's not if we're not at a moment where suddenly is going to look very different a year, 2 years down the line.
Not really. I think this phenomenon has been, and the other counterweight to that is the enterprises, especially with their AI. I think their data need and the data growth is going to go exponential. And that also we see. And that is why our focus is on data center to data center connectivity in the enterprise space. And that has been growing very well as well. So I think these movements have always been there. I don't think this is of any particular concern as such. And that is why globally, Prashant, the entire area, while it's been coming down in terms of growth, while data growth has been there, pricing pressure brings overall revenue growth down. We have been doing fairly well in that segment with mid-single digit, and we think that we can keep up that growth for the next few years.
Mr. Lakshminarayan, thank you very much, sir. I think your investors would be happy and relieved with you laying that out. Appreciate you joining us here on CNBC TV18 as always. Good luck. We take a quick commercial break here. We're going to focus on one sector, quarter se quarter tak, the next segment, and I think FMCG is in focus. So Mangalam will be here to lay it out for us, and we'll go across to Amit Purohit from Elara for some perspective. Okay, as promised, it's our special segment, Quarter Se Quarter Tak, where we get you earnings expectations from one sector a day. Mangalam is here with FMCG in the spotlight. Mangalam, morning.
Good morning. So remember the previous quarter, I said the tagline for the sector was same, yet different, because things were looking like they're improving. And this time we go with green shoots are coming. Why do I say that? Because, if you look at it, in the recent times, the stock moves itself showcase that belief. In the month of July so far, the FMCG index has actually outperformed the Nifty by 5%. Even some stocks have rallied in double digits, some for specific reasons and some for good performance. So what's expected this time around? Good rural growth that continues. Urban, which was under pressure, is now seeing gradual improvement, signs of life out there as well. Raw material prices, while they are volatile, the worst seems to be behind them. And staples may outperform discretionary. That's the big headline this time around. Summer products, some of the categories did get impacted by unseasonal rains and strong competition across categories. But we have a peep into what a lot of these companies are likely to report this time around. Godrej Consumer's India business delivered high single-digit value growth driven by mid-single-digit volume growth. Marico said its underlying volume growth in India has been at a multi-quarter high, led by their value-added hair oil business, which grew in low double digits, telling you consumer sentiment has improved because this segment wasn't doing too well for them. Dabur too witnessed sequential recovery in demand with uptick in volume growth in both home and personal care and healthcare. Their beverages portfolio was impacted. There was growth in discretionary. You saw 31% for Kalyan Jewellers, Trent about 20%, 18% for Titan, and V-Mart Retail for 13%. But these stocks actually saw a decline despite optically strong performance coming in the top line. Why? Because the pace of growth slowed down and valuations, they're catching up. So staples doing better than discretionary. Among all the companies that are likely to report numbers this time around, we expect some weakness to continue for Asian paints, even as the environment for the paint sector is improving. HUL, Tata Consumer, Britannia, all of them likely to show incremental improvement. The one particular stock I'll be watching out for this time around, United Breweries, 10 to 12% revenue growth expected. There's a summer product. The company has increased its focus on premium offerings with all the regulatory navigation that it has to do. That will be important to track. For the entire sector, speaking about strategy, the most important thing will be strategy of new leaders. We have a bevy of new leaders at HUL, Nestle, Pidilite, Titan, Bajaj Consumer, and many more. Further improvement in urban consumption will grow. And finally, scaling up of the recent acquisitions, for instance, HUL having bought Minimalist, etc. And finally, the valuations, all of them pretty close to or slightly below their 5-year average, even after the outperformance that we've seen in July.
Finally, in that valuation table that Mangalam has put up, there's nothing in the 70s. Otherwise, 70s and 80s used to be the norm for the sector. So at least from that standpoint, they've come down. Thank you for that, Mangalam. Let's take the conversation forward. Amit Purohit, Vice President at Elara Securities, is with us to give us how, his whole perspective. Amit, the market is squarely focused on FMCG, bottom of the pyramid consumption, growing, volumes growing. Do you think it can happen in a sustained way? Is this that milestone turnaround quarter for FMCG?
So yeah, thank you for having me. So clearly, there are some signs which are there with respect to normal monsoon, base effects getting favorable for the sector. I remember last year, second half is when the things got worse, especially companies calling out that urban demand started to slow down quite significantly. And that impact would kind of annualize as we move ahead in the second half of this quarter. This financial year. The second part is obviously the overall hope and expectations of a better monsoon, which will aid into better income growth for the rural and rural growth, which has been talked about, that rural has been growing ahead of urban. That momentum should continue as we expect a normal monsoon this year. And that would ensure that there is no significant downside risk, hopefully, as we move into the second half.
So let's talk some numbers as well. In terms of just the best-in-class growth, like Mangalam was just telling us, watch for maybe companies like United Breweries or even Lever, at least mid-single-digit growth. In terms of best growth, what would be the top 2-3 companies that you'll look out for?
So our process is simple. We look at companies where these segments are building growth for the future. So maybe over a 3 to 4 year perspective, companies who are investing behind that. So there are 3 important companies which are kind of building up for the future, which I would say. One is Marico, Godrej Consumer, and Tata Consumer. Each of these companies have shown some product innovation or building acquisitions or inorganic growth to build up the growth levers beyond their core categories. So, and most of them, especially like a Marico or a Tata Consumer, a good 25 to 30% of their portfolio will become the growth portfolio, which is growing anywhere between 15 to 20% or even higher. And that would actually provide the necessary engine for growth. So our preference remains on these kind of names. And obviously the other names where the trajectory or the growth has been good, although this quarter seasonally things were not favorable.
Amit, sorry. I'm just going to go focus on the names again. You said Tata Consumer, Marico and Godrej.
Yes.
On a full year basis, what is the growth you're expecting them to deliver? Whether we can talk volume growth or we can talk top line growth as well?
Sure. So Marico would largely be around high single-digit volume growth with double-digit revenue growth, largely driven by price increases that copra increase in copra prices forcing Marico to take that. This quarter as well, Marico is likely to report 20% plus kind of a growth. For GCPL as well, there is a mid-single-digit volume growth this quarter, and for the full year also we are expecting a mid to high single-digit volume growth with overall growth closer to high to double-digit, low double-digit revenue growth. Tata Consumer again will be a good double-digit revenue growth for this quarter as well as the full financial year effort.
All right, hi Amit, good to see you. If you have to look for that one earnings surprise this quarter, what would you think? Which stock could that be? Because you have a bit of a cheat sheet that comes out, right? So some part of the results are already known a little bit ahead. But which could be that number that we should really look out for?
So yeah, you're right. I mean, some of the quarterly updates are already out. And I think now more than the revenue growth, the surprise could come somewhere around the margin side is what our sense is that to some extent, Marico or a GCPL, probably if there is any surprise or better than our expectation of the margins, there could be some positive surprise in that. And some outlooks from the companies like Tata Consumer on their growth portfolio or HUVR talking about the outlook going forward and with the recent management change. Some cues on that would probably be some surprises which will play out in the quarterly numbers.
So the thing is, the stocks have also moved higher. I mean, the market's now started positioning for this recovery. So now the final question then, now we've spoken about growth, you map the valuations and the stock run up with it, then which would be your top picks? For instance, if I look at Marico, where you're expecting strong growth, stocks up about 6% so far this month. So again, marry growth and valuations together, and then what are your top picks?
So, I mean, our premise has been for quite some time that companies in FMCG which grow double-digit are the ones which will be preferred more over the companies which will have challenges with respect to top-line growth. And in that context, I think if I look at Marico, reasonably valued at 46 times FY27, could probably, as we go along and the confidence built up, you would see that this inching up further with respect to the multiples as well is what our sense is. Similar is the story if I look at Godrej Consumer, where the multiple is closer to around 46 times based on our estimate on FY27 basis. And hence, I think these are the companies where you have some uptake in one, the revenue growth trajectory, and second, as well as some comfort on the valuation as well.
Okay. All right, Amit, interesting conversation. And let's see, because actually these stocks, the Nifty is up hardly 6-7% this year. But some of these stocks where there is a promise or a hope of growth building, they're up. Look at Tata Consumer. I mean, this year it's up almost 20%. Marico is up 13-14%, all outpacing the Nifty already. So interesting times for the consumer space. We'll quickly move on to our 10 a.m. calls. We've got Mitesh back with us. Mitesh, so how do you look at the market now? Again, dealing with a bit of a decline. What are the trades?
So actually, sir, I've been advocating that we might have a stronger chance of heading towards the lower levels, closer to about 24,900 zones. With today's stick, I think the support levels have moved slightly up to about 24,900. I think that's an area where I would explore some long positions on the index. But for the time being, the structure is negative, despite the fact that a lot of stocks are doing good. The advanced decline is also not too bad. What is interesting is that the bank Nifty is showing first signs of weakness. It opened gap down with that Axis Bank numbers possibly. And since then, the gap has not been filled and we are now heading towards the low of the day. So the bank Nifty could head towards 156,400, which we are not very far away from. But more realistic target would be around 55,900, which could be tested. So in that sense, a slight negative view on the bank Nifty would suggest that the Nifty could also be in decline.
Okay, all right. Couple of stocks?
Yeah. I have a buy on Manappuram with a stop at about 270 or maybe 269.5 and look for targets of around 285 over here. And on the sell side is Max Health. Keep a stop at about levels of 1240 and look for targets of around 1185.
Got it. All right. Thanks a lot for that, Mitesh. Just a quick word on Nuvoco. In the first tick itself, we said the stock has run up 10% and it already gained close to around 8%. So maybe bulk of the good news is in the price. Now the stock is up only around 2%. So just keep an eye out on Nuvoco. While the South-based companies, KCP, Sagar, there is that buzz that could be some consolidation out there. Probably with the Deccan Cement. We don't have any confirmation on that. But KCP as well as Sagar Cement, both of them buzzing on very, very high volumes for the first hour of trade. Time to slip into a short break. On the other side, Manisha Gupta will be joining in to help us out with what's going on in the commodity space.
Welcome back. By the way, the equity market's looking a little tentative. We are at the lowest point of the recent trading range. I mean, we've not, in the last many sessions, the Nifty's not breached 25,000, but it's precariously close to that. And it's also fiddling with the 50 DMA as we're speaking. Anyway, let's shift focus to commodities and see if there are brighter headlines over there. Manisha is joining in. Manisha, some of the other commodities always sparkling and bright. Right. So you tell us, what's the news?
Oh, well, yes. Overnight, it clearly has been about platinum and silver. So platinum is trading at a new 14-year highs, but it is silver, and I want to talk about that because this one really seems to be holding quite well. There's a lot of interest into this as well in the Indian markets and globally as well. So we have the prices moving towards $38 an ounce. Since the time it has broken above 30 and 32, we've been looking at it making higher highs into the market. It has been in this week itself that we have seen silver hit at $39 per ounce as a level as well. Remember, this is a 5th straight year of deficit in case of silver. And yes, silver has hit $50 an ounce a couple of times earlier as well. But what really seems to be coming together this time around in sense of fundamentals is very, very strong. So in last 1 month, we've seen prices gain up by 5%. And in this year until now, we are up by nearly 32% in sense of prices there. Also, when you look at the global demand and supply numbers for this year, that tells you that the mismatch itself has been quite supportive. Remember, it's a 5th year of deficit. And in this year as well, we're looking at a demand of 1.05 billion and supplies at 1.2. So you are looking at some concerns coming in there as well. Apart from that, when you look at the overall fundamentals, there is strong investment demand. The ETF demand has been picking up, and the physical buying in sense of bricks and coins also has been on the stronger side. It also has been about strong industrial demand. If there's a switch that goes on and off, there is silver in it. Solar, electronics, electrification, EVs, AIs, semiconductors, you talk about it, laptops, phones, aircrafts, silver usage is only going higher. And the markets do believe that by the time it's 2050, it would be semiconductors and photovoltaic, which would be 55% of overall silver demand. Another interesting point is that there is no resale happening. People are not getting their silver into the market thinking that they can make use of this because they believe that the prices will go higher from here. There is almost absent in sense of profit taking as well, and that has been keeping the prices supportive. This is the other thing, which is the gold and silver ratio. We did hit 101 at the beginning of this year. We are trading at around 87, 85 at this point in time. And that tells you that the silver still has an upside to go. The jewelry used in silver, because the gold prices are trading at an all-time highs, so silver as a substitute there as well seems to be doing quite well. So everywhere that you see, we are looking at stronger fundamentals. Tariffs, geopolitics, gold prices going high, safe haven buying, all of that in turn also has been supportive. And then interestingly, since Russia has said in September 2024 that they are looking to add silver to State Reserve Fund, I mean, this is the first central bank that really seems to be doing that. We've heard of central banks adding gold, but Russia is adding silver to its kitty as well. That has been supportive. And finally, the split tells you on what the markets are believing on where the silver prices could go moving forward from here. JP Morgan talks about 39, a level that we have seen, but they talk about 39 as an average price, so we still have an upside to go. Bank of America, UBS, Standard Chartered, Saxo Bank, everybody has talked about $40 an ounce of a possibility, and as early as the month of August. Interesting report coming in from Citi, where they believe that $40 an ounce for silver will come in 3 months, and they are anticipating $43 in the next 6 to 12 months as well. So bullish cues coming in across from banks and brokerages as well, and fundamentals in any case are quite bullish.
Okay, all right.
Okay, all right, Manisha, thank you very much for that. Well, with that, we do have to take another quick break. On the other side, Lata is in conversation with Mr. Puneet Chatwal of Indian Hotels. The company's come out with a very, very solid set of numbers for the first quarter. We get an outlook for the rest of the year in just a bit.
Welcome to Corporate Radar. Indian hotels' first quarter revenue growth has been about 32%. Profit has grown even better by 36.4%. Though these numbers, I must say, are higher partly due to the consolidation of Taj Sats. Now, margins at 28.2% also remain very impressive, even if this is a bit less than a year ago, which was at 29%. Also, the company has aggressive expansion plans. And on that note, let me welcome Managing Director and CEO of the company, Mr. Puneet Chhatwal. Mr. Chhatwal, thank you very much indeed for your time, and many congratulations on a day when the market is down, the stock is up, and it's been doing very well. Give us an idea of what is pushing this growth at a time when one would have thought it's a difficult quarter because of Sindoor. You would have lost business in Kashmir. The plane tragedy. In spite of that, it's a good number that you have done, even unconsolidated. What were the top 3 reasons that's working for you?
So, thank you, Lata. The first important reason is the strength of our brandscape. We are not anymore dependent on just one business or one brand. So the diversification of the brandscape and the diversification of the top line is a consequence of that. Number 2 is our asset management initiatives, which we have undertaken since several years. It's an ongoing thing that helps us to drive operating leverage in our capital-heavy portfolio, which is today 40% of the total. And finally, very important are not like-for-like growth on capital-light model. So our management fee income increase, if you see for the quarter, the number that we have used to be the number for the full year 5 years ago. So what we are doing as a management fee income, despite whatever you said, Operation Sindoor, geopolitical tensions, airline tragedy, etc., helps you to drive margins. And the little dip that is in the margin is because of a one-time adjustment we have made in the salary increases. We are giving it as of this year from 1st of April versus 1st of July. So in Q2, Q3, Q4, the increase will be a little lower because it's now divided over a 12-month period.
Okay, actually, your answer is throwing up a lot more questions. I intended to go in a sequence of margins and number of hotels growth. But you spoke about this management light concept or practice. You know, in the investors, after the results, you also spoke about the new Tata Sons platform for investment in select assets. Is that more of the same? That Tata Sons does the construction, you become asset light and earn more management fees? Is that how it will work?
Yes, they would be the owner of the asset, and we would have, we prefer, unless it's a Taj branded property, if it's a Ginger or a Vivanta, we would go for a revenue share model. So we also own the business. And I think it's really geared towards the new businesses and how to support that as another source of capital. And we are very pleased that it's finally happened, this platform, with the first asset coming at the Kolkata airport.
Okay. Well, then let me come to the here and now and then go back to your longer strategy questions. Q2 normally is a weak quarter, isn't it? At least in my community, we don't perform marriages during Ashad. So how is Q2 likely to perform? Can we again get this headline in your press release, 14th consecutive quarter? Will it be like that or will it be different?
We want it to be like that. We don't want that kind of formula to change. So we would like to come back and say this was the best ever Q2. Not just that, what you said, Q4 is the third strongest. We are coming from a sequential basis. And if we look at the weakest, it's always been Q2 in that order. So Q3 is the strongest, Q4 is the second strongest, then you have Q1, and then you have Q2. But the way things are going, there is nothing that makes me feel nervous about Q2 not working out well. On the contrary, I actually feel that again in Q2, especially the international contribution would be very positive, like it has been in Q1 from US and from London. And these are pretty big assets or big sources of revenue. So we remain fairly optimistic about the performance of Q2 also.
Okay. Let me come to expansions. You told us in the press release you opened 6 new hotels and signed 12 for this quarter. That would make your portfolio, what, 392, is it?
Absolutely right, Lata. It's impressive.
Okay, no, I just did the numbers now. Now, does this look like then that your 2030 goal will be achieved earlier? You did that with that Avahan, if I remember right. You all did it a year earlier. So your 2030 goals also may happen earlier?
We always say, I can only keep repeating that we promise, we deliver, and in an ideal world, we deliver a bit more than we promised and a little earlier than the deadline that we have given. It has happened twice with Aspiration 2022 and Avant 2025. In an ideal world, Accelerate 2030 should do the same.
Okay. Let me come to these other businesses you spoke about. Lately, Taj is not hotels. You all are defining yourselves as, shall I call it, the hospitality ecosystem. You have Amas, you have J Wellness, many, many innovative ideas. Would there be more? Are you all thinking, not for this quarter, not for necessarily only this year, but are there any such concepts that you have in mind?
Absolutely. There are many others that we could do, which have not even come in a significant way in India. One of those, based on my past experience in Europe, is, something like all-inclusive, where you go, you buy a ticket for a flight, and your transfer from home to airport to the hotel and a 1-week stay with the family and coming back has just one price for a family of, let's say, 4. We haven't even gone anywhere close to that as a company, but also as a sector in India. And I think in a few years from now, this will come. Similarly, extended stay is a very important component. It's at a very, very infancy phase in India. So a lot of these new concepts, new businesses, service departments, etc., will come also in a big way as India continues to grow. And becomes the 4th largest, or has become the 4th largest economy, and will become the 3rd largest. So all these concepts will also come. And we, being at the forefront of this sector, will obviously try to develop these concepts. Also, belonging to a group that has significant other businesses and can be assisted through whether it's getting, the cars or getting the planes, we stand to benefit a lot from the synergies that a group can offer. So we will always remain open, and any idea that makes sense and is scalable. Very important, we will not do a one-off and stop there. Any idea that is scalable, related to wellness, related to extended stay, related to all-inclusive, and continuous innovation of what you already have, we will try to execute on that relentlessly.
Okay. Well, now let me come to the tougher part of the business. So many hotels, so many ideas would mean rapid training of staff. Are you seeing that as a challenge, both in terms of numbers and cost? Will that be something that will take away from margins or take away from quality?
Firstly, I'm very glad you asked this question. So quality, the test is with institutions that are neutral. I'm sure you read it. Taj was again rated as world's strongest hotel brand and India's strongest brand across all sectors. This is the 4th year in a row, and world's strongest, twice. We have had it in succession, and before that also twice in succession. So that is the proof in terms of the quality. But when it comes to training, it's a very important factor for us. And since last 3 years, we embarked on the journey of upskilling our people at all levels, from an apprentice to management trainee to middle management to the top management, absolute people in the executive committee of the company. We are spending a lot of money in doing that. And more importantly, under our ESG Plus program called Pathya, which just celebrated its 3rd anniversary, We have committed to skill 100,000 people by 2030, and we have achieved the number of 31,000. We've opened 52 skilling centers as part of our CSR contribution, plus our work with Tata Strive to contribute towards nation building, to contribute towards skill building. And I think all in all, not just for us, we are doing our utmost to contribute to the sector at large, but also the younger population in India, taking them from their rural sectors and skilling them rapidly and making them fit for working in our sector so that they can benefit from our businesses.
Okay. Now, I'll tell you, there are some of your very elite customers who have a different kind of complaint. Because the general upper middle class, the rate of growth of that class is high, its consumption proclivity is probably high. You know, look at your occupancy. I mean, 75% year after year, quarter after quarter. And I guess in TMPT, in Taj Mahal Towers, you may be going at over 90%. There are your elite customers who say it sometimes looks like a bus stop. It's just that the number of rich are more. So do you even think of a super brand?
Yes and no. So we are always looking at brands, but you know, the Taj Mahal Palace Tower is not just the flagship of the Taj brand, is not just the temple of hospitality, as we affectionately call it. It's a national monument. You know,
Yes.
people who come to Gateway of India just come in there and just to see the lobby, take their pictures with the flower arrangements. And that's something we have to learn to live with. We cannot just close our doors to the national population, because when there is also something bad happening, like the attack, the terror attack is also called the attack on the Taj, right? So it comes with both positives and this kind of challenges. But we are all in all very pleased with such an iconic asset, and the more the people come, the better it is. And some who don't like, we will create a new entrance for them from the back so that they can avoid the traffic if they so want to. These were closed because of that terror attack. It's not that those entrances did not exist before. All the planters that you see in front of the property and the other entrances that were closed were done for security reasons. And we are in conversations with the city and the police to slowly start opening on those.
Okay. No, actually, this is an extremely humane, so very Tata reply that you are giving. I mean, it's something to be appreciated. But actually, I was not referring only to the Taj Mahal Palace and Tower. I mean, generally, there are your very, very elite customers. You know, we get a lot of CEOs. Our daily job is to meet some of the super rich. There is a feeling that, you know, there is a crowd of upper middle class which is now there, and the exclusivity, therefore, in some of your other hotels is lost to them, to this very small sliver. But that discussion another day, out of time, numbers very impressive, and all the very best for the next quarter, Mr. Chhatwal.
Thank you, Lata. Thank you for having me.
Well, that's the word. At least we end on a high note in terms of a company, its performance and its stock price in the green. But otherwise, it's a lot of red on the markets today. Chartbusters will take the action forward after the break.